for me, what attracted me to Clearwater is my mother-in-law is in the Tampa area. And so we're down there a lot. And my family loves to go to the beach and spend time down there. We love Clearwater. And so for us, it just made sense to be able to, go to visit my mother-in-law, be able to stay at our place when we're there. It becomes a tax write-off going to visit mother-in-law now because you're taking care of your properties and visiting them. And so, there's some additional benefits there.
Welcome to the Physicians and Properties Podcast, the show where we teach you how investing in real estate can give you the freedom to practice medicine and live life how you want.
Doctor! Doctor! Doctor!
Doctor! Doctor!
Now, here's your host, Dr. Alex Schloe.
Hello, everyone. Welcome to another episode of the Physicians and Properties Podcast. As always, I'm your host, Dr. Alex Schloe, and I am so excited to be joined here by Dr. Chirag Chaudhari. This is going to be a fantastic episode. Dr. Chaudhari is an emergency medicine physician and a multi-asset investor. He's built a diversified portfolio spanning multifamily, short-term rentals, oil and gas, and preferred equity, which we haven't yet talked about on the podcast. So looking forward to that. We're diving deep into how one ER doctor turned his clinical precision into a framework for evaluating deals, mitigating risk, and building true financial freedom. Dr. Chaudhari, so glad to have you on the podcast. How are you doing today?
Doing great. Dr. Schloe, thanks so much for having me. I really appreciate being here.
Absolutely. Feel free to just call me Alex, and I'm looking forward to get started. So how did you first get interested in medicine? Let's talk a little bit about your journey into medicine, if you don't mind.
Yeah. So sort of interesting story. I went in, sort of graduate high school. My dad was an engineer. I was going to be an engineer. I got into the University of Illinois as an electrical engineer and was sort of doing the first year of, basic engineering level classes. And it was great, no arguments there or anything, but I had 3 roommates at the time and all 3 of them were pre-med. And so, that's all they'd be talking about. They'd be talking about their classes, and they just seemed so much more energized and amped than I was with my engineering stuff. And so I ended up, sort of auditing a bio class and loved it. And so ended up switching majors halfway through sophomore year, and then did a double major in bio and psych, and then realized, medicine, did some shadowing and volunteering, and sort of maybe came to a decision a little bit later than some other folks. But after that, it was sort of, my heart was set on medicine and, being a doc.
That is awesome. Feel like it was the right decision for you?
Yeah, absolutely. Would not change a thing. Oftentimes people ask, if you had to do it over again, what would you do differently? And honestly, nothing. It's been tremendous. I think, just being able to practice, being able to live in sort of, the area of medicine that we live in. And we know things are changing and it's sort of not the same practice as when we got into, but I wouldn't change any of it. It's been a tremendous experience.
That is awesome. What did things look like after undergrad, going to med school, going to residency? What was that path like for you?
Yeah, so undergrad finished up at U of I, and then, kind of born and raised in Chicago suburbs, kind of wanted to stay close by. And so ended up doing med school at Rush in the city. Met my wife there, who, like you, is actually a Northern Virginian by birth. And so she wanted to sort of head back out east. And so we matched at the University of Maryland, did residency there in emergency medicine, and then stayed put, one of the community hospitals as part of the University of Maryland network. I've been there, PGY 21 this year. And so 21 years at the same place, which again is a little bit unusual and a little bit of a unicorn, but it's a terrific system, terrific hospital, terrific group. And so, I've been there a long time.
That is awesome. Well, congratulations on those 21 years. That's really impressive.
Thanks. Appreciate it.
Yeah, absolutely. Was there a moment for you when you realized, hey, maybe I need to pursue some other asset classes or investment opportunities to create financial freedom? Or how did you kind of get bit by the real estate and investing bug? Yeah,
I think so. Unfortunately, in sort of medicine and medical school, and I think times are changing a little bit with some of the education that's out there, but we don't get a lot of financial education. We don't get taught sort of investing strategies. You hear a little bit about contracts and what those look like and, how not to get taken advantage of. But I don't know that we do as good of a job with our finances and financial education. And a lot of times we become prey to financial advisors and other folks that are sort of selling, permanent life insurance and other things to residents who are going to have, a pretty good net worth down the road. And so they get you when you're vulnerable, when you're young and sort of uneducated. And so, having some of those discussions, learning a little bit, but being cautiously, fearful of some of those folks, I think was healthy. And then fast forward to attending hood and sort of, getting some of that larger income now that you're maybe not used to as a resident. Where do you put it? You have, the usual 401k, 403b, 457, depending on, your employment. That sort of, a lot of folks will describe as money jail. And I think it's a perfect description because you're sort of, hey, you get, these 6 to 8 options of what to do with your money, and then you can have it at 65 and enjoy. But there's not like, what if you want to enjoy it before you're 65? What if, you want to try alternative assets and maybe something that's not particularly offered? And so we were always a little risk averse with the market. And so we would get a bonus at work and we would buy a home. And so we would get different investment properties early on. And so by the time we're probably a decade into sort of attending hood, we had 3-4 properties, and that was going to be the retirement plan and just cash flow those. And yeah, interestingly, we got into investment properties, which were by a nationwide home seller that really didn't want to own model homes. And so they would sell out of a community, for example, and instead of owning those model homes, they would just sell them and rent them back to an investor. And it could take them 2, 3, 4 years sometimes to sell out an entire community of homes, which is perfect because I didn't have to be a landlord for 2, 3, 4 years. I had monthly checks coming in. The owner of the home is me, but my renter is the builder. They're not even living there. If something goes wrong, they're going to fix it. So it was perfect. It was a great cash flow, great for an early investor. No headache, no fixing, no getting light bulb calls and fixing toilet calls in the middle of the night kind of thing from tenants.
That's awesome. Yeah, that's really unique. I've never heard of that opportunity, but it makes a whole lot of sense. And yeah, it gets rid of the toilets, the termites, and the tenant issues that exist there. So that's great. Do you mind kind of walking us through the evolution of your portfolio from that first investment property to your current holdings? And then from there, we'll kind of digress into talk about some different strategies and what that looks like for you.
Yeah, absolutely. So we had sort of a series of homes, and initially we're in Maryland. We had small amounts saved up, but nothing to sort of typically you're putting 20% down on properties and things like that. And so we looked just over the border in Pennsylvania, where the properties were significantly less. And so our first investment was in Pennsylvania, and we actually just sold that one last year. So we owned that for probably almost 2 decades. And so and then 1031 that into sort of a larger asset, but we owned it outright. We our tenants over a decade or so paid down our mortgage, and we had cash flow, we had rental income, and what was sort of a $150,000 townhome in Pennsylvania that we put down maybe 20, 25K has now purchased a short-term rental in Clearwater. That's a $600K home. We didn't put $1 down for that home. It was just whatever we put down 18 years ago, and we've just used that to sort of grow. And that's, I think, the property, the power of real estate and what you can do, with a small amount upfront and sort of grow that for years to come. And so same strategy. We did that multiple times with a number of other long-term rentals. And so we have another short-term rental there as well in Clearwater. And so we've 1031'd a few of our homes into short-term rentals. They tend to cash flow significantly better than a long-term rental would. And so we, each one that we did that with, we 10x the cash flow that the long-term rental was doing compared to what the short-term rental does. And so same plan is to eventually 1031 those into potentially larger short-term rentals or potentially multifamily properties. And so we still have a number of those holdings. But then in 21, we changed our strategy, did a bunch of masterminds, several different courses that sort of taught us how to be a little bit more intelligent in the real estate we were doing. And so that's what really led us to sort of converting those properties and 1031ing them, and then brought us into passive real estate investing, which, was a completely different animal, if you will.
That is awesome. I want to hit on a couple key points before we talk a little bit more about the passive investing. But one thing that I noticed you said was, 18 years later, you sold this home and you bought the short-term rental in Clearwater. And we're kind of talking about that snowball or velocity of money. Real estate is not a get-rich-quick scheme, but you've done it and you've done it right. And it's really cool to see, kind of how that progression has gone from that $150,000 townhouse, free and clear, sold, bought a $600,000 Clearwater short-term rental. It's cash flowing like crazy. So that is really, really cool. For folks who aren't familiar with a 1031 exchange, do you mind kind of explaining briefly what a 1031 exchange is and what the benefits may be to doing that?
Sure. Yeah, absolutely. And I would say in hindsight, we would compress that 18 years now into something much, much smaller, just given the education and the learning, which we didn't have back then, which is why I think your program is so terrific, because I think it offers that education to folks that are looking potentially to do something similar. Looking back, we would have taken that equity and 1031 much sooner, probably as soon as the community was fully built out and sold. We could have then sold the model home, which was sort of the cream of the crop property in the community, and 1031 much earlier, and we'd already had significant equity built up. But we still did it, and it was still a great play. And so a 1031 is a like exchange of property. And so it allows you, there are certain timeframes that you have to meet, but it allows you to sell one property, purchase another one, as long as you use all of the gains from your first property without sort of taking any of the gains yourself. And so it's handled through an intermediary that holds on to the cash from your sale and then puts it towards the cash and the down payment on your next purchase. And so you have to identify a new property within 90 days of sale. You have to close within 180 days of sale of your first property. So there are some time constraints you have to stick within. But what's great is you're not paying a penny on any of your earnings, no tax. And so you're able to sort of kick the tax can down the road and buy bigger properties that theoretically will cash flow even better for you. And it depends on what you read and who you listen to, but eventually you get into a large enough property and then you just pass that on to your heirs. And that's a step up in basis is what it's called, to your heirs, which means they get to take it at whatever the current property level is and whatever it's appraised for. And nobody's paying any taxes because you've now passed, your heirs have the asset, and you've not paid taxes at all on the history of that money, which is pretty amazing.
Yeah, it is absolutely incredible. It is such a valuable tool that you can use to defer those taxes down the road and maybe forever. So yeah, thank you for sharing that. And thank you for mentioning the compression of time. You're exactly right. That's the true benefit of podcasts and masterminds and communities and courses is, hey, how can you take that 18 years that it took you for that deal? How can you compress that time to 2 or 3 years and continue to use that velocity of money where you're making that money work for you faster and faster and faster and generating more and more returns that's going to continue to snowball down the road. So thank you for pointing that out. That's a really important point.
Yeah, absolutely.
That's awesome. Well, let's talk a little bit briefly about short-term rentals. So what drove you to the Clearwater market? What drove you to short-term rentals? What do you like about short-term rentals at this point?
Yeah, so I think short-term rentals is just it's a niche market. It's sort of, the next big thing. Everybody's staying in Airbnbs, everybody's staying in Verbos, and it just provides a little bit of a different experience for folks. And given, people do short-term rentals for different reasons. Some people want it at a location that they enjoy vacationing, that they're able to enjoy their, vacation home, if you will, while also having the home essentially paid for many times by folks who are staying there. And people offer amenities for their short-term rentals. Sometimes they're seasonal based on ski vacations or beach vacations. So it could be a lot of different things. For me, what attracted me to Clearwater is my mother-in-law is in the Tampa area, and so we're down there a lot. And my family loves to go to the beach and spend time down there. We love Clearwater. And so for us, it just made sense to be able to, go to visit my mother-in-law, be able to stay at our place when we're there. It becomes a tax write-off going to visit mother-in-law now because you're taking care of your properties and visiting them. And so, there's some additional benefits there. But what was nice, once we started the first one, we sort of had our team there. We have a property manager that, handles our bookings for us and everything. We have general contractors. We have folks that we know. We have a pool person for each of them. And so it just became easier to do a second one there because we sort of had that infrastructure in place and made it easier to set up a second one. But yeah, that's what drew us down there.
That is awesome. Yeah, what a cool way to make visiting mother-in-law a tax write-off. So that is awesome. Short-term rental is certainly more active in terms of investing and managing and run that. Of course, you have a manager who helps streamline that. But you mentioned that you, in 2021, started doing some more masterminds, some more courses, and you started to pivot more towards more passive investing or more of a limited partner situation. What has that looked like for you as you've made that transition?
Yeah, so I think that's been a really good transition. Just one other thing in the short-term rental, which not only does it allow for higher cash flow annually than you would get through a typical long-term rental, But one of the masterminds I went through really concentrated on the short-term rental tax loophole. And as long as you meet, again, certain criteria around material participation, and the amount of time that you put into the property, you have to get what's called a cost segregation study done, which is an engineering study of all the improvements that you made through the home. And you're able to bonus depreciate those and take a lot of those, which would normally be written off sort of 20, 30 years, depending on the particular asset. You could bonus depreciate that all within 1 year. And that actually comes off your active income. So your W-2 or 1099 income. So the first year I did it, I had a $200K loss almost off of my active income. And to imagine like not paying taxes on $200K of clinical income, it's dramatic. And that is a very large check back from the IRS, fully legal. It's all in the tax code, but it's a great business play to be able to do and offset, some of the hard work that we're all doing. So sorry, I know that was a little bit of a tangent, but I think important for folks to hear.
No, that's a perfect tangent. And I would encourage folks to go back and listen to what Dr. Chaudhari has been talking about, because we've hit multiple really cool tax strategies. And I think sometimes the benefits of real estate, we kind of overlook how massive of a benefit from a tax perspective it really is. But when you're talking about a $200,000 loss that's written up against clinical income, I mean, we're talking $40,000, $50,000 in tax savings from that perspective, perhaps more. But it is a really, really awesome opportunity from that perspective. And I can tell that you've been very diligent and analytical as you've thought through, hey, how can I figure out these tax strategies that are going to benefit me, not only from an investing perspective, but also against that clinical income. So that's probably a little bit of that engineer brain that is working that out. But that's a really, really important point for folks to think about, especially making a little bit higher income as physicians. So we're grateful for that, but we pay a lot of taxes. And so it's great to be able to offset that and do it legally. So that's awesome. Well, yeah, let's pivot now towards more of that transition to a limited partnership arrangement or more passive strategy. What's that look like for you?
Yeah. So I think with the active things, at some point, a lot of active takes a lot of time. And depending on how clinical folks want to be and how much they want to be active in their real estate, a passive component to a portfolio is great because it's sort of, it's a lot of your money working for you as opposed to you sort of working for your money. And as long as you do it thoughtfully with a good strategy and you do the appropriate due diligence, getting into these limited partner deals are great because you're still investing in real estate or not, but you could do multifamily, you could do land syndications, there's storage, there's, you name it, there's so many different asset classes one could get into. And you're basically a partial owner of that asset. And so you're pooling a lot of funds and you can be a part owner of a very large apartment building. There's oil and gas, which, I'm a limited partner in over 22 syndication deals currently. So it's a lot, but it's also very risk stratified and sort of diversified in the sense that there's so many multiple asset classes that they're not sort of correlated to market. And depending on what the market does, these things are going to do very differently. And so even if a number of them don't perform as well as one would expect, if you're in 22 of them overall, you're, very conservatively, you'll double sort of my investment at that 4 to 5 year mark. And then if you keep doing that and keep doubling every 4 to 5 years, not a lot of years that you have to do that before you're sort of, free from other things, at least from a cash flow point.
Yeah, absolutely. That's a great point. And kind of what we mentioned earlier of just that snowball continuing to grow over time. And before you know it, you've really made, a huge dent in your financial freedom journey, probably already surpassed what you need from a financial freedom perspective. But let's talk about those 22 deals. So you mentioned you're pretty risk stratified. How did you decide how you wanted to stratify your risk or what asset classes you wanted to invest in?
Yeah, so initially I knew nothing about passive investing or syndications or any of those. So I did a course and sort of learned. And the important thing is there's a lot of folks that'll take courses and then do nothing or not finish the course. And so I sort of made a very purposeful decision that I'm going to do a course. I'm going to learn the material, but then I'm taking massive action. I'm going to jump in and I'm going to, and so I took the course and within 3 months of finishing the course, I was in 6 different syndications. And I did my due diligence. I did not what I do now because that was a few years ago and I know better, but it was also just my wife and I. And so there wasn't, the risk was just us two. And, so our due diligence looked a little bit differently than it does now. But some of those deals that have been performing really well and other folks that I've gotten to meet over the last couple of years just through masterminds, we now bring others into those deals. So, you'll say, hey, instead of taking my 50,000 or 100,000, what if we gave you 2 million, 5 million? What does that look like for all of us now? Because we want better terms for all of us when we can come in collectively. And so we negotiate, nicer profit split or lower minimums or whatever it is, so that all of us, and I'm now bringing family members and colleagues and other folks into these opportunities, because we're able to come in at larger numbers and therefore get better terms in the long run.
Yeah, absolutely. I want to hit this because I think this is a really important point. Personally, as someone who has raised capital for deals, largely in the senior living, assisted living space, you get limited when you have, a $50,000 or $100,000 minimum in terms of not only your network and your reach, but also how you can provide really good investor relations to those folks. Because of course, if we have 10 people who are each investing $50,000 for $500,000, that's 10 people we're sending emails to, 10 people we're communicating with, all those sorts of things. So what Dr. Chaudhari is mentioning is pulling that money together and investing as a group, for example. Then we have someone come in, say for $1 million or $2 million, and we're communicating with one main point of contact. We're oftentimes able to offer higher returns, largely because it's just easier and a more simple arrangement, but also it's just more flexible in that regard as well. So I just wanted to make sure we hit that point because that is really, really cool and a good strategy to do that. And then ultimately it juices the returns for you guys as an investor in the deal as well.
Yeah, absolutely. I think it's spot on because, the folks that we partner with and those partners are really great at operations and they do their own fair share of capital raising as well. But if you ask them which two do they love and would prefer to do all day long, it's the operations. It's running the asset. It's being the experts at what they're experts at and allowing other folks to kind of come in and bring in the capital like you suggest. And therefore, they're not talking to a lot of investors. They're not talking to a lot of people. And our due diligence is just that. We get to know the deal inside out and backwards. We spend 4 to 5 months doing due diligence. We have an economist that will help us kind of look at numbers and run all the different sensitivity analyses and downside risk and upside potential. We do criminal background checks on everyone that we work with, just because when you're bringing in several $1 million, of sort of family and friends money, you want to be very careful with all of that. And so we try to take every possible step that we can, sort of doing the right due diligence.
Yeah, absolutely. Super important to be a good steward of people's hard-earned money, and a lot of pressure that goes into that. But setting yourself up for success with the due diligence that you guys are doing is really important. Yeah, well, I think now might be kind of a good time to talk a little bit more about the community and co-investing and kind of what that looks like. I do want to make sure we talk a little bit more about your involvement in that 787 unit hotel to multifamily conversion and some oil and gas as well. But let's talk a little bit more about kind of that co-investing or community aligned capital and what that looks like. How do you guys typically structure your deal? Say a physician wants to invest with you and invest in a deal that you guys are doing due diligence on. What does that typically look like? What's that structure look like for folks?
Yeah, so typically we'll come in as an LLC, as one sort of large investor that's coming into any opportunity. And so all of our investors will come into our portal. They'll do all of their documentation. Most of our opportunities are for accredited investors, and you have to meet sort of the IRS definition of what an accredited investor means. And so they'll come in, they'll show proof that they're an accredited investor, they'll sign all their legal documents, and they'll wire sort of funds into that account. And then all of us collectively then invest as one investor into whatever asset it is that we're investing in.
That's great. Yeah, kind of like a fund-to-fund model, it sounds like, from that perspective. Yeah. Awesome. Yep. Awesome. Yeah, so everyone invests in, and then one big check gets written to the operator for the deal. That is awesome. And I'm sure it's certainly deal specific in terms of what returns, look like and what you guys are investing in. But is there an overall goal for you guys? Is it cash flow? Is it appreciation? Is it tax benefits? Is it a mix of all the above? What's that look like for you guys typically in terms of your buy box?
Yeah, so I think that's kind of the really neat thing about us is our investors tell us what they're looking for, and then we go and find it. And we find those sponsors, we find those operators. And many times we've known sort of folks that we've, thought about, doing a sort of a relationship with, but haven't had the interest or the need necessarily. So there's a lot of our investors that do have passive income from real estate, and they're looking for opportunities where they can get some negative K1 losses, from depreciation to offset some of their active or their passive income where they're not paying taxes on any of their rental income, for example. So we've done that. There's other folks that want monthly cash flow. So we found opportunities that will do that. There's other folks that say, look, I'm good. I don't need any cash flow whatsoever. I want you to take this amount of money and grow it as quickly and as massively as you can. And so there's an asset class. So for example, that's land. We do a number of land deals where we essentially buy the land, it gets rezoned and then sold to a developer. So there's no development, there's no ground up with those deals, but there's no cash flow, there's no depreciation. It's just dirt that we're buying, but it offers 3 to 5x returns within, 3 to 5 years. And so that 100K becomes 3 to 500K in 3 to 5 years. It's a pretty great return, but more so for folks who don't need that cash flow in between. And then others, have asked for active tax benefits. And so they don't want to do the short-term rental tax loophole because that's a lot of work and they don't have the time and they're not interested in actively running an asset. And so they said, how else can I drop, my active income? And so energy deals will do that. So oil and gas, it has to be very specific type of oil and gas where you're getting IDC credit, which is intangible drilling costs. And so as long as you do that, what we're going in with sort of very large operators. So your Exxons, your ConocoPhillips, just very large companies and buying less than 10% share of any well. So that allows us to get 50 to 100 wells to, again, diversify sort of that risk. We're multiple states, but it allows us to then offset 80 to 90% of an investor's initial investment off their active income. So again, a 100K investment, that would be 80 to 90K off of a W-2 or 1099 this year, which is great. It's just another way to sort of, and you're getting an immediate return next year when you file your taxes. So it's a quick return on your investment within that first year as well.
Yeah, that's really cool. I don't know much about oil and gas, energy investing. What are some of the highlights? You already mentioned a lot of the tax benefits with the IDC credit, but what does that typically look like? What's an energy deal typically look like?
Yeah, so I would say it depends on the way the deals are structured. I'm in another one of them as an LP and I'm getting monthly checks from that one currently. And, that one is luckily performing to pro forma. Ours is structured a little bit differently in that there's a very large sort of tax advantage up front. So, let's say 30% of your initial return will come back via check from the IRS in the tax return. And then conservatively, we're planning for a 20% cash flow. It likely will be higher, but we're saying 20%. But that's a 50% return on your initial capital outlay within 1 year. We've never done a deal that will return 50% of capital within a year. And drilling, and I know, there's a lot of sort of ethics and sensitivities around oil and gas. Our stance is it's here. Yes, we're looking at alternatives and we can't wait for that. I drive a vehicle that doesn't operate on gas, and so, in medicine, where saline bags are made out of petroleum and artificial heart valves, and there's so many petroleum-based products, so it's not going away anytime soon. So, biases aside, the asset offers significant cash flow upfront and early. And it's funny, I talk about, sort of wells and oil production as like draining an abscess, right? You sort of go in, you drain that abscess, you get this, big sort of return of product, and then it sort of dribbles out. And so that production trails off within, 3, 4, 5 years or so. So it's a deal that goes 5 to 7 years, but you're going to get the vast majority of your return very early on. And so sort of the IRR, if you will, the internal rate of return is significantly high because of that quick return of capital. And then you can reinvest it into another deal, a different asset class or something else. Meanwhile, you're still getting monthly cash flow for the next 5 to 7 years, in your initial investment.
That's awesome. Yeah. Well, we all know how gratifying it is to drain a really good abscess. So I'm sure it's more gratifying to get cash deposited into your account after you invest in an oil and gas deal. But that's really cool. Definitely something I want to learn more about. I did not know about the active tax benefits with those IDC credits. So that's really interesting for folks to look into and see, well, hey, maybe an oil and gas deal that gets these credits might be something that's quite favorable from a tax perspective. And then, of course, as you mentioned, with the IRR being more time bound and having that return upfront really can make those IRRs quite substantial from that perspective. Well, that is awesome. I want to hit too, if you don't mind. I know you are working on a 787 units of hotel to multifamily conversion. Is that correct? How's that been? What's that look like for you?
Yeah, so it's been great. That's a property out in Olympia, Washington. And it was a sort of one of these dilapidated hotels that was purchased and turned into studio housing, sort of affordable studio housing. And that conversion's been done. It's getting leased up. And so working with a fund that does a lot of them, and that's their sole sort of niche, is turning hotels into multifamily properties. And so hotel, it's sort of a different asset. They can be bought sort of at a lower price point. And when they're turned into multifamily and converted that way, they sell for significantly higher amounts. And so being able to get them leased up and ripe for sale is sort of that business model. And so that's been great. Expected to generate a 2.5x equity multiple. And so 2.5 times the return of the initial cash investment at the 5-year mark.
That's awesome. Yeah, I think it's a really cool opportunity as folks start to get more and more creative about, hey, how are we going to solve the affordable housing crisis? How are we going to solve the senior housing crisis that we're running into as well? And I think that this is a way to potentially do that is, hey, can we take some of these older hotels and can we renovate them to be more effective properties, whether that's for student housing or affordable apartments or senior housing? So it's really cool to see how those properties are being repositioned from that perspective.
Yeah, no, absolutely. It's been fun to watch for sure.
That's awesome. Well, what is something that you look for when you're vetting an operator, when you're vetting a deal? Are there any few, like key tips or tricks that you may have for someone who's looking at getting started investing in their first LP deal?
Yeah, absolutely. I would say, there's a lot of different things to sort of do, and you want to vet the sponsor, you want to vet the deal. Vetting the sponsor is really important because you want to know sort of what do their operations look like? What is their kind of reason for doing what they do? Are they providing a social service? Is it about their investors? Is there a charitable component to what they're doing? And those kind of things will align with different investors. But you want to look at their track record. Do they have a track record? Are they just starting out? And looking at, not that past performance is going to be indicative of future performance, but it sure as heck helps, right? And so to be able to look at that track record critically, see what they've done, see, well, was that what you said you were going to do? Try to find out what their initial pro forma and what their initial prospectus said. They can say, hey, we gave 2x returns to all of our investors, but you look at the prospectus and they said they were going to do 5x. What happened, right? And so while it may be nice just to look at it, you want to dig in and try to get some of those details. The deal is very important. Obviously, you want to look at how do they come up with their assumptions? How conservative are they being? What is the absolute worst case scenario? We all know what that is. It's zero. You lose all your capital. But for their opportunity, what are the risks? What have they looked at? What happens with tariffs? What happens with purchasing costs of supplies and all of these kind of things? What happens if interest rates do what they did back in 20 and 21? And have they thought through this? How many economic cycles have they gone through? And I will say between the two, bet on the jockey, right? Not on the horse, right? And the jockey is that sponsor, that's the operator. If you have a good sponsor operator, they can take a bad horse and make it do better things, right? They can squeeze out what they need out of the deal. So out of the two, if you had limited time, you want to spend it on the sponsor, on the partner, and spend a lot more of your time on that due diligence. The deal is equally important, but of the two, it's who you're working with and who you're getting into business with. That makes all the difference.
Absolutely. That was really well said and great advice. What are some mistakes you've seen physicians make when they're chasing returns without fully understanding risk?
Yeah, I think, they're just looking at a deal deck. They're just looking at a pitch deck, and that's all marketing, right? That's created by people who know what numbers to put where and at what level of the document and in what colors so that they're, very appetizing to us. And look at that, but you need to look at it critically. And anybody can make numbers. We all know that with any of the data and the metrics that we're looking at hospitals, et cetera. We can make the numbers say what we want them to say. And so definitely look at that very critically. Don't just look at what a sponsor is telling you, but definitely dig into those details because, again, as you said, Alex, you're putting your hard-earned money into these deals and you want to do that wisely. And if you don't have time, find other folks that are doing podcasts like Alex and have him steer you in the right direction, and other folks that are doing some of this work and are super passionate about, looking at deals critically and talk to them and ask them, have them, look at a deal with you.
Yeah, that is really awesome advice. It's important to take the time to dive deeper. And I think there's, fortunately we live in an age with AI, so that can be helpful as well. Of course, you get in what you put out you get out what you put into AI and analysis, but that can be another way that you can kind of help, check the marketing materials and so forth and see, hey, do the numbers make sense? And what are some things that I'm missing? I found that's been a good way to kind of analyze the marketing materials and also come up with some questions that can be beneficial to ask the sponsor as well, utilizing, AI and prompting it with like, hey, I want you to pretend that you're a top real estate attorney in this market. What are the key things I need to look out for in this deal? And it can really help guide you from that perspective. So that can be a good first pass for people as well.
Yeah, that's a really good thought. And it's almost like, it's like getting a curbside consult, right? And just with a really good prompt and putting in a pitch deck and say, look at this critically. What should I be worried about? And, tell me like you said, the top 5 things here that I need to ask about. It's great. And it does it so quickly and efficiently. And the questions it asks are actually pretty thoughtful a lot of times.
Yeah, absolutely. I wouldn't rely solely on AI, but it's definitely a helpful tool. Man, this has been awesome. This time has just absolutely flown by. But I wanted to ask you, what are you excited for? What are you working on right now?
Yeah, I think, it's been tremendous. Honestly, this started just myself, kind of getting into this and learning. And so much of this is, I wish that somebody 10 years ago had tapped me on the shoulder, and maybe 18 years ago for my first property, but just saying, hey, there's a better way, right, to sort of do this. And if there's anyone listening that gets even one iota or inkling of an idea, home run, mission accomplished, right? It's just about going back to our younger selves and saying, hey, there's this whole world of opportunities out there. And I wish somebody had, introduced me a decade ago because, again, I wouldn't change a thing that I've done. We talked about that before. I'm super happy, but I'd be in a much different place if I'd started this 10 years ago. And so I think that's it. That's the strategy. Go out and learn those things that, that fill your cup, that give you passion, that you're super interested in, and then pay it forwards, right? We're all here, abundance mindset. We want to help one another out. And, it's terrific. So I really appreciate everything that you're doing for your listeners.
Thank you so much. Yeah, that means a lot. And I completely agree. I think that's been something that's been so cool in the space to see how the willingness and the abundance mindset that other physicians in the real estate and investing space have for others, because we've all had that experience. We've all experienced, some degree of burnout and realized the importance of some degree of financial freedom as well. And so we're just here. We want to help, the community grow. We want folks to realize how real estate and entrepreneurship can truly give them that freedom to practice medicine and live life how they want to. So for folks that have felt inspired by this podcast, how can they reach out to you if they want to know more, if they want to connect, if they want to potentially invest with you?
Yeah, so my website is thesyndicationdoctor.com, and you can find me on there. I do a newsletter with mostly educational topics, and if we have an offering or something like that, we'll put it on there. My email is thesyndicationdoctor@gmail.com. So I'm usually pretty responsive on email, happy to respond back and help out, whatever questions or ideas that people have. Always, I'm at the point where I never say no to a conversation. And so you never know what you learn. There's so much learning to be had. So yeah.
Absolutely. Well, awesome. Well, this has been fantastic. Dr. Chaudhari, thank you so much for coming on the Physicians and Properties podcast. And I wish you a lot of great success going forward.
Thank you so much. And thanks for having me. Really appreciate it.
Absolutely. Take care. Thanks for listening, everybody. Hey, real quick, if you're still listening to this, I'm assuming you got value from it. So I need your help specifically. My 2-year vision with this podcast is to help 100,000 physicians learn how investing in real estate can give you the freedom to practice medicine and live life how you want. There are 2 main ways that a podcast grows. One is through ratings and reviews, and the other is word of mouth. If you can please leave me a 5-star rating and review on Apple Podcasts and Spotify, as well as send this to 1 to 2 friends that you think would get value from it, we can reach the physicians that we want to reach. Thanks in advance, and talk to you on the next episode. Please note that the information shared on this podcast is for informational purposes only. It should not be considered financial or medical advice. The views expressed on this podcast are those of the host and the guest and do not necessarily reflect the views of the Department of Defense or the United States Air Force.